Hi traders, in this video we are diving into the best oscillators for day trading, the indicators that help spot momentum shifts, overbought and oversold conditions, and potential reversals. So whether you are trading Forex, stocks, or crypto, using the right oscillator can give you an edge in your strategy. So make sure to watch until the end because I'll also share a pro tip on how to combine these indicators for even stronger signals. And if you find this video helpful, smash that like button, subscribe to the channel, and turn on notifications so you never miss an update. Okay. All right, let us get into it. First of all, let's quickly define what an oscillator is. An oscillator is a type of momentum indicator that fluctuates between a set range, typically between 0 to 100 or minus 100 to plus 100. So these indicators help traders identify when an asset is overbought or oversold, meaning the price may soon reverse or slow down before continuing its trend. Oscillators are useful in range-bound markets as well as trending conditions when combined with other indicators. Now let's just break down the best oscillators for day trading and how to use them effectively. The first oscillator we are going to be looking at is the Relative Strength Index, or the RSI. Now, the RSI is one of the most popular oscillators used by traders. It measures momentum on a scale from 0 to 100, with values above 70 indicating an overbought market and values below 30 indicating an oversold market. Okay, so above 70 is overbought, below 30 is oversold. How do you use it? You look for RSI above 70 to anticipate a potential pullback or reversal. Look for RSI below 30 to find possible buying opportunities. All right, combine RSI with trend analysis to confirm trade signals. The next indicator we're going to be looking at is the Stochastic Oscillator. All right, the Stochastic Oscillator compares a security's closing price to its price range over a specific period. Like the RSI, it moves below 0 and it moves between 0 and 100, with readings above 80 considered overbought and below 20 considered oversold. So how do you use it? When the percentage K line crosses above the percentage D line in oversold territory, it can signal a potential uptrend. When the percentage K line crosses below the percentage D line in overbought territory, it suggests a downtrend. Works well in sideways market. This indicator, the stochastic oscillator, it actually works well in sideways markets where price fluctuates within a range. Okay. Now, the next oscillator we are going to be looking at is the MACD, or the Moving Average Convergence Divergence. Now, MACD is a trend following momentum indicator that consists of two moving averages, the MACD line and the signal line. When these lines cross, it generates buy or sell signals. How do you use it? A bullish crossover, which is when the MACD line crosses above the signal line, it suggests an uptrend. A bearish crossover, which is when the MACD line crosses below the signal line, indicates a downtrend. Okay, so you might also want to look for the MACD histogram bars to gauge the strength of the momentum. Okay, when you have the bars increasing in length, it shows that the momentum is strong. All right, but when you have the bars decreasing in length, it shows that the momentum is weak. Okay, now the next indicator we are going to be looking at is the CCI. All right, the Commodity Channel Index. The CCI is another powerful oscillator that measures the deviation of price from its statistical average. Unlike the RSI and the stochastic, the CCI does not have a fixed overbought or oversold levels, but values above plus 100 indicate strong upward momentum, while values below minus 100 suggest strong downward momentum. So how do you use it? CCI above plus 100 signals a strong trend continuation, while CCI below minus 100 may suggest a trend reversal. Okay? Now, the CCI also works well when combined with support and resistance levels. Okay? The CCI works well when combined with support and resistance levels. Now, here is a key takeaway for you, okay, before we wrap up. Never rely on just one oscillator. We have discussed 4 oscillators so far. These indicators are good, right? And they can give you good signals on their own. However, the best way to improve your accuracy is by combining 2 or more oscillators to confirm signals. For example, you can use the RSI to identify momentum and the MACD to confirm the trend direction, right? You can combine the stochastic oscillator with the CCI to refine your entry points. You can watch for MACD crossovers and then check the stochastic oscillator for confirmation. So by combining oscillators strategically, you filter out false signals and make more precise trading decisions. Okay, and always make sure that you pay attention to your risk management. Do not trade with an amount that you cannot afford to lose, and do not risk more than 2% of your account balance in a single trade. All right, also make use of good risk to reward ratios. Okay, now that wraps up this breakdown of the best oscillators for day trading. These indicators help traders identify key turning points in the market and improve trade timing. Okay, if you found this video helpful, hit that like button and subscribe for more powerful trading strategies. And let me know in the comments, which oscillator do you use the most in your trading? Turn on notifications so you never miss an update, and I'll see you in the next video. Happy trading.